So diving into my strategy, what is it? What is it that I want you to follow? Let's go through that together. So the first thing that you're going to be understanding is liquidity pools and how they form. So this is one of the most important concepts inside of the market. If you can't identify where the liquidity rests, 9 times out of 10, you're going to become the liquidity. And this is exactly how you can start identifying the liquidity. You will only be focusing on external liquidity pools and that's it. So this is how all high probability trades are going to form once you can identify where the external liquidity rests. And you're going to focus on swing highs and swing lows. This is going to be the external liquidity that's going to be made inside of the market. And then the next thing is you're going to focus on 3 candle bars. This is what makes a swing high and a swing low. And this is where your dealing range understanding is going to stem from. Once you can identify external ranges, then your dealing range is going to be made on this understanding. If you can understand external ranges and external highs and lows, you will have a dealing range fractal. So if you have a large dealing range, you can have a smaller dealing range within the range. So what do I mean by you can have a range within a range? So if we look right here on this picture to my right, we have a low and we have a high. So this is an impulse low and this is a swing high. Impulse lows are basically where price trades into a PD array or a liquidity pool, and then it has a reaction away. So here, this became an impulse low, and this becomes our swing high. And this is our dealing range, but if we look at the picture below, you can see this is the external high that we mapped out right here, and this is the impulse low. So this is the same fractal, but you guys can see we build another dealing range within this range. So we have this candle's high that I'm pointing at right now, and we have this candle's low. So this is our dealing range high, this is our dealing range low within the overall range. So you guys can see, what do we take out first? We take out the impulse low first, then we take out the new dealing range low first. And as you can see, once we take out one side of the range, we go ahead and target the other end, which is this candle's high, and it's the swing high that was made right here. So time frame alignment is going to be subjective to the type of trader you are. So depending on what kind of time frames you like to execute on, that's going to be the alignment that you're going to be using. So if you trade on the 1 minute chart, you'll be focusing on the 15 and the 30 minute for your dealing ranges. And if you're a day trader, then you'll be focusing on hourly and 4-hour ranges. And then if you're a swing trader, you'll be focusing on weekly and daily ranges. And on those time frames, that's where you're going to utilize your understanding of liquidity pools, and that's where you're going to map them out. Now we're going to go over dealing ranges, and this will be touching up on your understanding of external liquidity. So we will be using swing highs and swing lows. This is what's going to make your dealing range. And if we have no dealing range, this equals to no trade. And most importantly, if we don't take external of dealing range, this equals to no trade framework. So if we have no range, there is no trade. So if we have no range, this equals to no trade. And if we don't take out one side of the external range, this equals to no trade framework. So as you guys can see right here, we have a dealing range, we have this low, and we have this high. Once we take out one side of the market, so we take out the low, we have framework to look for longs because we've already taken out the sell side liquidity. And above this high, we have buy side liquidity, and this gives us the framework to look for longs. If we look right here, we take out no external liquidity. So we have a high and we have a low. And you can see the market's not taking out any external highs or external lows. So this is where you won't trade because you have no framework to work off of. So this is going to stop you from losing trades and trading inside of a range like here. So this range right here, this is made for you to lose money because no external liquidity is being generated. So if you're trading within this range, this is where the liquidity is being generated and you're becoming the liquidity inside of the market. So everything I just explained regarding dealing ranges will be used for your new understanding of premium and discount, which we are going to go over right now. And now we're going to go over premium and discount and my approach to premium and discount. So once you know the liquidity pools and how I identify them alongside the dealing ranges, you need to understand where we are in relation to a premium or a discount. So this is where you're going to be grading the price swings. So this is basically how you do it. As we went over regarding dealing ranges, you need to map out your dealing range high. So this is the range high and this is the range low. So what makes this the range high? Well, this was the most recent swing high that was made inside of this fractal before price traded lower. Once we traded lower, we made a range low. So what makes this a swing low? Well, this is the lowest low made in the fractal, and you can see this candle right here. This is our first candle. This is our second candle, and this green candle right here is our third candle. So we have 3 candles which make a swing low or a swing high. And you can see the candle to the left and the candles to the right fail to go below the candle in the middle. So this now becomes a swing low. So this is our range high and our range low. So this is our dealing range, which we went over before. So the way ICT has taught premium and discount is if we're above 50%, then this is a premium. And if we're below 50%, then this is a discount. Well, the algorithm doesn't just view 50% as a premium or a discount. You can start to look at 0.25 and 0.75. And this is grading price swings, 25%, 50%, and 75%. This is going to be key. So 0.25 is 25% and 0.75 is 75%. So if we close or we react away from these levels, this is going to tell us where the market's going to go. So if we look right here, range high and our range low. So this becomes our dealing range, and this is where you map out your Fibonacci tool. And you guys can see we reject away from 0.25. So once we're trading this live and the market is not closing below 0.25, this shows us that the market wants to trade higher. So once we trade higher, we trade into 50%. So this is the area that I'm pointing at right now. And we get a closure above 50%. As we close above 50%, we can anticipate the market to trade into 75%. As we trade into 75%, this is important. So if we close above, we don't anticipate the market to trade back to 50%. We anticipate the market to take out the range high. And as you can see, this is what we do. As we close above 75%, we don't anticipate the market to trade into 50%. And we trade into the buy side liquidity. And the same is done at 50%. You can see as we closed at 50% and we closed above, we don't anticipate the market to trade back lower and come back to 25%. And we just anticipate to continue trading higher. And this is how you're going to be utilizing premium and discount. And we are going to go over some chart examples soon, which is going to make this understanding much more easier. Okay, so now we're going to be blending the understanding of everything we just went over. So if we look right here, we have a swing high and we have a swing low. So as we spoke about, this is our external high and this is our external low, and this holds liquidity. Being able to identify liquidity, you'll be able to see the dealing range you're within and the relative external highs and lows. So the external liquidity that I've taught you with swing highs and swing lows, this comes together with your dealing range understanding. So this is our swing high, this is our swing low, and this is also our dealing range. For the high probability trade setups to form, we want to see the market take out one side of the dealing range. So as you can see, we take out the dealing range low and we take out the sell side liquidity. So with this understanding of your dealing range and your external liquidity, this is where your understanding of premium and discount comes into play. So we have our range high, which is right here. This is where you take your Fibonacci tool, and from the range high to the range low, this is how you can confirm the market wants to go higher. So as you can see, this orange dotted line right here, this is 25%. And you can see the market is rejecting away from this level. So what do I mean by rejecting away? Well, you can see no bodies closing past 25%, or this orange line right here. So as no bodies closing past this level, we can anticipate the market to trade higher because no bodies close past this level. Then if we look at 50%, which is right here, the market closed above 50% with a body. As we closed above 50% with a body, this confirms the market wants to go higher and then target the range high. As you can see, we take out the range low and then we target the range high, and then we can use our understanding of premium and discount. And the final step, which is the easiest step, is entry inside of the market. The hardest thing is identifying where the market's going to go. And with this strategy, it makes it easier to know where the market's going, and then entry becomes very, very simple. So these are the three keys to execute my profitable strategy and understanding how the market moves. Lastly, you will look to enter once every step is in sync. If not, then no trade is valid. And then this is exactly how you will be entering your trades. With your new understanding of price action, you will always be trading a valid market maker X model. So if you're trading a market maker buy model, so the market trading to the upside, you will only focus on entering once price trades into down close candles. And if you're trading a market maker sell model, you'll be focusing on green candles to enter from to trade lower. So as you guys can see right here, the area that I'm pointing at, this is a market maker sell model and price is trading to the downside. So this is where entry becomes very, very simple. You are just looking for the market to trade higher, trade into a green candle. So you can see we trade into these green candles. This is an entry, and we have these green candles right here. And this is what we trade into, and this is another entry. And you can also see how sensitive price is at these levels. And we have another set of green candles we trade into, and then we reject away. and this is our next set of green candles we trade into and reject away. So this is all entries within the market. Then we have a market which is trading to the upside, and all you are utilizing is down close candles. So you can see this is a down close candle, this is a down close candle, and this is a down close candle. And every time the market trades into them, it rejects away and trades to the upside. You can see right here, this down close candle, no bodies close past it. You can see how it's rejecting away. This is very sensitive, and this is what the algorithm is referring to. So with everything I've just explained, how is entry so easy? Because you know where the market's going to go. So if the market's going to the upside, this is exactly how you will be entering, and this is exactly how you can utilize it. And if you know the market is trading to the downside, this is exactly how you'll be entering, utilizing green candles. So the important thing is understanding your external highs and external lows, your dealing range, and then entry becomes very simple because you know the draw on liquidity that the market's going to go to. This is it. Entry does not need to be hard. When you know where the market's going to go, 90% of the job has been done. So everything I went over in the first few slides, this is what we are going to go over inside of the charts as well. So this is a rough overview of everything. Now we're going to dive into the charts for a deeper understanding. Okay, so now we're going to go over some charts examples, and this is basically everything you need to know about the markets and everything I utilize. So everything we went over in the slides regarding external liquidity, dealing ranges, premium and discount, and then changing the state of delivery, then entry. This is all going to come together when we go over the examples right now. So it doesn't matter what kind of trader you are, but this logic applies to every single time frame or however the way you like to trade. So here we are going to go over an example of when we have a 9:30 open. So before the 9:30 open, you guys can see this is the range that we're in. And how can we identify the dealing range? Well, this is where we're going to simplify this. So the first things first, we identify your external range. So this becomes our low. And why does this become our low? So this was the last low that was made that traded into a fair value gap, and then we expanded away. So this becomes a swing low, and this also becomes a impulse low. So here we have our swing low, and then what does this high become? This high becomes our swing high. Why is this our swing high? Well, this is the 3 candle bar pattern that I spoke to you guys about at the start of the video. This candle failed to go above this candle's high, and this candle failed to go above this candle's high. So this is a swing high. So this becomes our dealing range. But this is not only just a swing high, this is the highest high made within this range. So this becomes the highest high of the range. This is our swing high. This is our swing low. So this is now our external liquidity. And what also does this become? This now becomes our dealing range. So we have our external liquidity, which is buy side liquidity above this high that I'm pointing at right now. And we have sell side liquidity below this low that I'm pointing at. So this is our external liquidity pools and then our dealing range. So what do we do now? We wait for one side of the external liquidity to be taken. So if we don't take out one side of the external liquidity, you don't do anything. So this is before the 9:30 opening bell. So this is the liquidity that's being generated. So as you can see, when you sit in front of a blank canvas chart, you can now identify what to look for and not just trade within the range. You're waiting for specific things to happen inside of the market. Then you can get involved and take your high probability trades. So now all we do is wait for the 9:30 open. Okay, so if you look at this dotted line that I'm pointing to, this represents the 9:30 open. And what did we do at 9:30? Well, first things first, we took out the swing low. So this was our external low, and we took out the sell side liquidity below it, and then we took out this low. Once we took out this low, what did we leave? Well, we left the external high above here and right here. So this is the buy side liquidity. So the first things first, once we got into the charts, we were able to identify our dealing range, and we identified external liquidity, and the market took out one side of the external liquidity. What is the next step we wait for? Well, we look for premium and discount. So you look for the highest high within the range. So if we look right here, so from this high to this low, this is your premium and discount. So if you don't have my levels for premium and discount, right here we have 0, 1, 0.5, 0.75, and 0.25. So if you want to take a screenshot of this, feel free to do so, because this is how you're going to view premium and discount and what we're about to get into right now. So you can see everything is coming together. Before, when we were looking at the chart, it was just blank and we really had no idea where the market was going to go. But with this new understanding, you're able to map out areas that you're looking for the market to go. Once the market reaches there, you're looking for specific things to happen. Once they happen, then you can enter inside of the market and you have a high probability trade. So what was the first thing we looked at? Well, we looked at external liquidity, which was above this high and below this low. So as we identified our external liquidity, this comes hand in hand with our dealing range. So this was our dealing range low, and this was our dealing range high. Once we were able to identify this, we look at premium and discount. So we look at the highest high of the range and then the lowest low of the range. So why is this the lowest low of the range? Well, this is where we took sell side liquidity and we traded below the external low. So as we traded below the external low, this is no longer the lowest low anymore. And why are we even looking at the premium discount levels? This is because we want to see the market trade higher. So if we want to see the market trade higher, we need to see it respect these levels or reject these levels to show us if it wants to trade higher or not. So once we have these three things coming together, the external liquidity, dealing range, and premium and discount, you look at the premium and discount levels. So you can see this is the 0 level, and this orange shaded area or the dotted line, this is the 25 level. And at this level, to confirm the market wants to trade higher, you want to see it close above 50% and no bodies should close past this orange level. So once all of this has come together, your external liquidity, dealing range, and premium and discount, the next thing you wait for is a change in the state of delivery. A change in the state of delivery is when the market closes above a down close candle. So I'm using this down close candle as our change in the state of delivery because this was the most recent down close candle made before we traded higher and we closed above. So as we closed above this down close candle, this represents a change in the state of delivery. So I'm neglecting these two down close candles. Why am I neglecting them? Because they don't have a lot of volume in them. So they're just very small candles. I like to look at beefier candles. So this is the beefiest down close candle. Once we close above right here and we close above 50%, this represents a change in the state of delivery. So this is the 15-minute chart. And this is how I like to map out my dealing ranges and do everything before the 9:30 open. So once you're able to identify this, external liquidity, dealing range, premium and discount, change in the state of delivery, the next thing is entry. And after the 15-minute chart, you can move on to the 5-minute chart and you can look for an entry on there. So before we move on to the 5-minute chart and I show you how to enter inside of this fractal, I want to show you how this all looks without the drawings or everything that I've shown on the screen right now. So if you look at the screen right now, this is a blank canvas chart and there's nothing on there. So without my logic that I'm teaching, this is how you would be viewing the market. And you can't really tell where the market's going to go. But when we look at the market through the lens I'm teaching, makes it very simple. All you need to do is identify your external liquidity, then your dealing range. So your external liquidity and dealing ranges come hand in hand. So this is the dealing range high, this is the dealing range low, and this is our external low, and this is our external high. And then we look at premium and discount. So the highest high, and then the lowest low. And then we look at closures above and below these levels. And then once we see this, we wait for a change in the state of delivery. So we change the state of delivery once we closed above this down close candle. Once we closed above this down close candle, what do we do next? Well, we move on to the lower time frame and look for an entry. And I'm about to show you, as we know the market's going to go higher, it makes entry very, very simple. Okay, so on the 5-minute chart, you can see that this was the down close candle I had mapped out for the change in the state of delivery. So for entries, what are you guys looking for when you're bullish? Well, I'm telling you to only look at down close candles for entries. So here we have a set of down close candles. Once the market closes above these down close candles, this is where you can buy long. And as we close above this down close candle that I'm pointing at, this is where you can buy long as well. So as we're bullish, you're anticipating every single down close candle to support the market to continue higher until we reach the external high. And as you can see right here, these are the down close candles I've drawn out. Once we get a body which closes above these down close candles very strongly, this is going to support the market to continue higher. Okay, so if we look at this down close candle with a line that I've drawn out, you can see how the market is reacting at these levels. It's very sensitive and you can see no bodies are closing past this area. We're just rejecting away with wicks. So as we're rejecting away with wicks, this was the next down close candles that I had mapped out. And as you can see, this candle opens up, trades lower, trades right into these down close candles and rejects away. So this is how easy it is to enter inside the market when you know the draw on liquidity and the way I'm teaching. So what next? Well, this is another down close candle and this down close candle should support the market to trade higher. As you can see from this gray shaded area, once we trade into this down close candle, we reject away. And then we have another set of down close candles. So we map them out. Once the market trades into them, this should support it to trade higher. So there you go, we trade into the external high, and this is how simple entry becomes when you look at the market through my lens. So you can see we closed above these down close candles, we rejected away, no bodies even closed past here. Once no bodies closed past here, you look at the next set of down close candles, which were these two, and we wait for a closure above. Once we close above, this candle trades lower, trades into the down close candle, rejects away. Where is the next down close candle? This is our next down close candle. Market trades into it, then we reject away. And then where is the next set of two down close candles, which is right here. So this candle opens up, taps the high of this down close candle, and then rejects away, then trades into the external high. So this is how every high probability trade starts off. You map out your external liquidity. Once you know your external liquidity, you have your dealing range. So these two come hand in hand. Once you can identify them, you look at your premium and discount through the lens that I am teaching. Once these 3 points are coming together, you're developing a high probability trade. Once they come together, what is the next thing you wait for? Well, for extra confirmation, you wait for a change in the state of delivery. Once you have a change in the state of delivery, the final step, which is the easiest step that I just showed you, when we're bullish, down close candles are going to support the market to go higher. And when we're bearish, up close candles are going to support the market to go lower. And I'm about to show you an example of when we're bearish right now, but this was an example of how we are bullish, and I hope it made sense. Okay, so now we're going to go over an example when we're bearish. And the first things first, what do we do when we go in front of a blank canvas chart? You look at your external liquidity. Well, we have this high, this is our dealing range high, and this is our dealing range low. So what makes this our dealing range high and what makes this our dealing range low? Well, this is a swing low and this is a swing high. So this is a 3 candle pattern that we look for swing highs and swing lows. And you can see the market is stuck within this range. As we're stuck within this range, what is this? This is building up liquidity. So now you've identified your liquidity. So this is your external liquidity. We have it above this high and we have it below this low. And what do we wait for? We wait for the market to take one side of the external liquidity out. So as I said before, the external liquidity and dealing range works hand in hand. So you have your external liquidity and this is the dealing range. So what is a dealing range? A dealing range basically is where we have a high and a low, and this is where the market trades within. So similar to external liquidity, or the way I'm teaching you about external liquidity. And all we do is wait for the market to take out one side of the liquidity. Okay, so as you can see, the market trades higher and we take out the external high and we take out the dealing range high. And now what is the next thing we do? Well, we map out our premium and discount. So this is the lowest low right here, and this is the highest high that's made right here. And what are we looking for? Well, we are looking for the market to trade lower and close below 0.25%. Once we close past 0.25, then we wait for a change in the state of delivery. So as I said before, where does a change in the state of delivery come from? If we're bearish, we're looking for the market to close below green candles. So over here, this is my preference. When we have 3 candles that are stuck together, I like to use them as one, and they are the ones that I use for a change in the state of delivery. So we have 1, 2, 3, and wait for the market to close below these 3 green candles. Once we close below these 3 green candles and we close below 0.25, this represents the market wants to go lower, and we can tick off change in the state of delivery. Okay, so as you can see, the market trades lower. We close below these green candles, and most importantly, we close below 0.25. Once we close below this level, we don't anticipate the market to trade above 0.25. We can anticipate the market to come back where? Into these green candles. Why? Because as we're bearish, we want to see green candles support the market to trade lower, like we did right here. You can see we trade into this green candle, and then the market rejects away. However, this is not where we're going to enter from. Why don't we enter from right here? Because we're waiting for the market to tell us that it actually wants to go lower. And how do we know that the market wants to go lower? We wait for a change in the state of delivery. As we got a close below these 3 green candles, this represents a change in the state of delivery. So if the market wants to trade higher, trade into these green candles and 0.25%, it can do, and this is where we're going to sell from to target the external low. And as you can see, we trade higher, we trade into 0.25. And not only that, we trade into these 3 green candles and then we reject away. So why am I using 3 green candles right here? As I said, for a rule of thumb, if we have 3 green candles or if we have 3 down close candles, I like to join them up as one and the market trades into them and we trade away. So this is how easy entry is. We're looking at green candles to support the market to trade lower. So this was a green candle, but we did not have a change in the state of delivery. We change the state of delivery. Once we close below this low that I'm pointing at with a body, once we close below here, we look at the next set of green candles. which are right here. Market trades into them. And now what is the next set of green candles we can look at? Well, it's these set of green candles. And if the market trades higher, we can use them to sell. But you can see once this candle opened up, it traded higher, traded into these green candles, and then we traded away. As we close past 50%, we'd anticipate the market to trade into 0.75 and then finally into the external low. And as you can see, we trade into the external low. So I'm going to remove the drawings on the screen right now like we did before, and I'm going to show you the market, how it looks without everything that I've explained. Okay, so this is a blank canvas chart, and this is how you would be viewing the market if you weren't looking at it through the lens I'm teaching you. So you can see that the market is just trading to the upside and the downside. You don't really know what to look for. But when I show you to look at external liquidity, dealing ranges, premium and discount, everything comes together and it forms a high probability trade. And you know the market's going to go in that direction because you can trust that everything is coming together and you know a high probability trade is around the corner. So if I put the drawings back on the chart, so you can see external liquidity, which was this high and this low. We waited for the market to take out one side of the external liquidity or the dealing range. Once we took this out, we look at our premium and discount. So the lowest low and the highest high made. Once we have our premium and discount, what are we doing? We're waiting for a change in the state of delivery. So the market closes below these three green up close candles. Once we close below these three green up close candles, we have a change in the state of delivery. Once we close below, we anticipate every green candle to support the market to trade lower. Why is this? Well, when we're bearish, green up close candles are going to support the market to trade lower. And when we're bullish, down close candles are going to support the market to trade higher. So once we have a change in the state of delivery, we have our entry. So we're looking for the market to trade back into these green candles. This is where we're going to sell from. Once we trade lower, we look at the next set of green candles. You can see this candle opens up, trades into these green up close candles, then trades away, closes below 0.5. Once we have a closure below, we don't anticipate the market to trade higher, and we look for it to trade lower and take out the sell side liquidity. So this is how every high probability trade forms, and this is how you should be viewing the market. We're going to go over one more example, then we will move back onto the slideshow. Okay, so here I have another example. So what is the first thing you do? You identify your external liquidity. So we have this low right here. This is our external low, and we have this high right here. So this is our external high. And what are we waiting for now? We are waiting for the market to take out one side of the external liquidity. So once we take out the external liquidity, we will look at our premium and discount. Then we can look for a change in the state of delivery. Then we can enter inside of the market. So before we do all of that, we are waiting for the market to take out one side of the external range. So this high or this low. Okay, so as you can see, we take out external liquidity. So we take out this low. Once you take out the external liquidity, what is the next step? Well, you look at the highest high, which is right here, and then the lowest low. So this is our premium and discount, and we are looking for the market to trade above 0.25 and trade into 0.5 and close above this level with a body. Once we close above this level with a body, what do we look at? We look at this down close candle. So we have 3 consecutive down close candles. So this is what I like to use for a change in the state of delivery. So once we close above these 3 down close candles, and the 0.5 level, we can move on to the lower time frame and look for an entry. We have the external liquidity ticked off. So we have the external liquidity ticked off, then the dealing range ticked off, and then we have premium and discount ticked off. And now what do we wait for? A change in the state of delivery, so then we can enter inside of that market. So as you can see, we close above 0.5 and we close above these 3 down close candles. So we have a change in the state of delivery ticked off, and we closed above 0.5. We can move on to a lower time frame. So this is the 15-minute chart. We can move on to the 5-minute or the 1-minute and look for an execution to trade higher and take out the external high. So on the 5-minute chart, you can see these are the down close candles we closed above, and we had a change in the state of delivery. So all down close candles are going to support the market to trade higher. So as we close above 0.5 and these down close candles that I'm pointing out right now, if we trade lower and we trade into this down close candle, this is an entry to look for a buy and then look for the market to trade higher. And as you can see, the market trades lower, trades into the down close candles and rejects away and trades strongly to the external high. So these trades that I've gone over, every single one of the trades have looked the same, all looked similar. So when you have a profitable strategy or something which repeats inside of the market, the trades you take are going to look the same as the ones previously. So you can see right here, this buy trade that we took, This was the same as the example that we went over at the start. And you can see right here the checklist, we look for the external liquidity and dealing range. This is where everything came together. So we had the external high and the external low. We took out the external low. So what is the next logical area for us to target? That is the external high right here. And we have equal highs. So once we have this, what do we look for? We look for our premium and discount levels. So we closed above 0.5 with a body. We don't anticipate the market to trade lower and trade back into 0.25. And we anticipate the market to continue going higher. So this was the confirmation to look for buys. And to look for an even more confirmation, we wait for a change in the state of delivery. So the market closes above, down close candles. Once we close above, down close candles, we anticipate the market to continue trading higher. So this is the extra confirmation. And then we can enter inside of the market. So when we're bullish, down close candles are going to support the market to trade higher. And then when we're bearish, up close candles are going to support the market to go lower. And this is how simple looking at the market from the lens I'm teaching you is. This is where every high probability trade is going to stem from. So if you can take this understanding on board, I know that it's going to help you improve in your trading. So just follow the steps I'm teaching. And if none of these steps are coming together, then you don't have a trade. If all of these steps are coming together, you have a very high probability trade that's about to unfold. So now, as we've gone over the examples, we're going to move back into the slideshow and finish off the course.